The 2020s have gotten off to a bit of a rocky start, at least when looking at market performance relative to some other decades like the 2010s. In 2020, we had a major market crash which saw the S&P 500 fall roughly 34% from its previous all-time highs. And at least by one metric, 2022 saw one of the roughest market downturns of the past century. Today we're going to be taking a look at each of the downturns we've experienced this decade, both from an individual investment perspective and from a more diversified portfolio perspective, comparing them to other market downturns throughout investing history and discussing 3 potential lessons that can be learned from them going forward. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a 30-day free trial of Audible and 2 free audiobooks of your choice, as well as a list of some books on money I'd recommend checking out with your free trial. So as I said, the 2020s have gotten off to a bit of a rocky start. 2020 saw stocks dip quite quickly starting in mid-February. However, they recovered basically just as quickly, setting new highs that August. So by the end of the year, things actually looked quite good. In fact, between the 19 different categories of US and international stock indexes that I track, 18 of them had positive returns that year, or a win rate of about 95%. The average return for that year was 16% for those indexes. And the only index that was down was the International Small Cap Stock Index, which lost 2.8%. Bonds, from one perspective, actually fared even better, with a 100% win rate and average returns of about 6.6%. 2021 saw the broader stock market rising pretty consistently, with the S&P 500 jumping around 28% and posting a 100% win rate across all stocks that I tracked. Bonds struggled a bit more, posting average returns of negative 0.4% and a win rate of just 38% for the year. Then 2022 began the process of a slower and more protracted downturn that stocks are still attempting to recover from to this day. But what separates 2022 from the prior 2 years, and honestly most down years in general throughout market history, is the fact that there was virtually nowhere for investors to hide. Due to a number of factors from the economic conditions of the time, the lingering effects from the previous couple years, the interest rate hikes, and more, a stunning 36 of the 39 investment categories that I tracked for this video, which encompass stocks, bonds, real estate, and alternative investments like commodities and precious metals, lost money before inflation. That's a win rate of just 7.7%, which is the lowest for any year since the late 1920s. The only investment categories that saw their values rise, again, before inflation, were T-bills, up 1.5%, gold, up roughly 7%, and commodities, up 24%. Given that inflation for the year is estimated to be around 8%, give or take, the only category that would have maintained its purchasing power for the year would have been commodities. That's what you call a rough year. Even if the losses were not as deep as they were in other major downturns like the Great Recession or Great Depression, the average depth of losses for all asset classes based on the indices that I tracked for this video was a little under 18% for stocks, 10% for bonds, 6% for precious metals and commodity-based investments, and around 26% for real estate, although it is worth noting that that's in the form of REITs. For all assets combined, the average nominal depth of loss was around 15%. Compare that to some of the deepest down years in the last century, such as the 3 that you can see on your screen now, and you quickly realize that as bad as it was, it could have been worse. With that being said, it was still a very rough year. And as you can imagine, with that 7% win rate, even the most well-diversified investing portfolios tended to struggle in 2022, as you can see on your screen now. Most basic portfolios posted positive nominal returns in both 2020 and 2021, but in 2022, almost all of them lost money, and usually the losses reach double digits. So what takeaways can we glean from this time period? Well, there are several potential ones, but I want to focus on just 3 today. The first takeaway is that the fundamentals are still crucial to finding sustainable financial success. Prior to 2020, it had been a while since we'd had a deep crash in the markets. Yeah, 2018 was a down year, but for most of the 2010s, markets were pretty cooperative. Prior to 2022, it had been a while since we had a prolonged downturn, especially one that was accompanied by elevated inflation and the changes in interest rates that often accompany it. We've experienced both of those scenarios now, and while I have no doubt that the markets and inflation will eventually get back on track, and thus far 2023 has had a promising start to that, these things take time. And that's broadly fine if your financial foundations are solid. In other words, if you regularly budget or at least maintain control of your spending, keep your burn rate and debts to manageable levels, maintain a healthy savings rate and emergency fund, and avoid doing things like over-leveraging your assets and investments, then barring some major bad luck, you'll probably be able to ride out the few years that it typically takes for these noteworthy downturns to fully work themselves out. But if for one reason or another you aren't able to do these things, it can be tougher to keep your head above water financially over the long run. The second takeaway is that we've been through worse in the past and come out the other side just fine. The 2020s have gotten off to a rough start. There's no doubt about that. Similar to the early 1980s, we've experienced two notable downturns in the first few years of the decade. And as we saw, 2022 was, at least by some measures, one of the roughest individual years of the past century, especially when considering the impact of inflation on our buying power. But even with all that, most well-diversified portfolios and even individual asset classes have still managed to make money during the decade to date. So if you found yourself stressing out about your asset allocation or other aspects of your finances that are within your control, it may be beneficial to consider whether or not some tweaking to your financial approach is in order. If not, take comfort in the fact that this too will pass in time. The third takeaway is that over the long run, successful financial approaches rarely change all that much, even if the metrics we measure them by do. Let me explain. Diversification is generally considered to be a solid long-term financial approach, as are the other fundamentals we discussed a minute ago, but it can be overshadowed by outliers produced using riskier or just less reliable approaches. Some examples in the investing world would be things like leveraged investing, day trading, trend chasing, and hyper-focused allocations. There's no denying that under certain circumstances, these approaches can outperform the more tried and true strategies, and sometimes to a staggering degree, especially in metrics that tend to change a lot more over time, like the 10-year rolling return figures, which by definition change at least once a year, and regularly by more than many might think. But the key is determining when those ideal conditions are going to take shape so that you can position your investments in a way that benefits from the approach as much as possible, and then shift your strategy to a different approach before that ideal environment disappears. Truth be told, predicting the future of investing markets like that is extremely difficult to do with any sort of consistency over the long run, which is why most people who try to actively invest their money, as opposed to simply taking a buy and hold passive index approach, tend to underperform their benchmark indices over the long term, even if they do manage to outperform significantly during small pockets of their investing career. Years of financial studies have indicated this. These approaches are never going to entirely go away though, because there is always the chance to outperform the markets. Some investors do it every single year. And whether due to having a different financial situation and set of goals, or simply due to discouragement of recent underperformance on the part of the markets, we can find ourselves tempted to make a switch. Sometimes this switch is for the best, if the switch better aligns our finances with our personality, risk tolerance, life situation, and goals. But other times, it's not, particularly if we're making the switch as an emotional reaction born out of recency bias. So in summation, during our financial lives, we'll likely live through several different financial environments, with outcomes that can be difficult or even impossible to predict ahead of time. Think of everything that's happened in the last 40 to 50 years that many recently retired individuals would have lived through, for instance. And that unpredictability is one of the reasons why those who stick with tried and true approaches tend to find more sustainable financial success than those who regularly try to over-optimize their financial progression. These tried and true approaches may never be the best performers in any individual environment. In fact, almost by definition, they never will be. But they do tend to perform good enough in a wide variety of environments that long-term, sustainable, reliable financial success is achievable to those that diligently work toward it. And just as a final side note before wrapping this video up, I wanted to take a look at how safe withdrawal rates have been holding up now that we've had a more protracted downturn to add to the dataset. And as it turns out, most of them have, thus far, remained largely the same. Here's a quick summary of the 30-year safe withdrawal rates for a handful of asset allocations we've looked at on this channel prior to 2020 and as of the start of 2023. As you can see, there wasn't any difference between the two despite us experiencing a pair of downturns and elevated levels of inflation to start the decade, at least in terms of the 30-year safe withdrawal rate. There were some differences in the perpetual withdrawal rates, simply because the latest year in the dataset, 2022 in this case, was a down year. But even then, the differences were generally fairly small. For example, the all-stock approach saw its perpetual withdrawal rate fall from 3.20% when only looking through 2019 to 3.18% when looking through the end of 2022. So a difference, but not a huge one, which is always comforting to see. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. If you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.